Hey, everybody. So today I'm speaking with Seth Bergida from the Madison Trust, an A-plus rated Better Business Bureau financial services company, about self-directed IRAs and how they can be used for tax-free real estate investing. That's right, I said tax-free on both capital gains and rental revenue without the need for 1031 exchanges. So, first of all, Seth, thank you for taking the time to join us.
My pleasure, Debbie. Thank you for having me.
All right, so let's get right into it. Tell us a little bit about what self-directed IRAs are and how they differ from regular IRAs and 401ks.
Sure, I'd love to. Let me just give a quick disclaimer first. Madison Trust is what's called a self-directed IRA custodian, which means that we custody the IRAs and we direct the money where you instruct us. But we're an agent of you. We're not even able to give investment advice. So it's really all self-directed. And I'm happy to have this discussion with Debbie, but it's not like Madison is endorsing any investment.
So you basically just let people choose their own investments through this platform. You're a financial services company, but people still make their own decisions about what they want to invest their money in. Is that right?
Exactly. And that to get to the question you just brought up, an IRA or 401k or pension plan, really any retirement money could be invested essentially anywhere. The IRS has very few limitations, including, insurance and collectibles, they want you to stay away from. But otherwise, the whole world of investment is open to you. What you're limited to is really the bank or the trust company that's holding your account. You're limited to what they'll accommodate. So most people have their IRAs or 401ks, let's say at Schwab or Fidelity or Vanguard, which will allow them to invest in Wall Street products, stocks, bonds, and mutual funds. Madison Trust provides what's called the self-directed IRA, which means that we'll hold your IRA and allow you to invest in alternative assets, whether it's real estate, precious metals. You really could do anything, cryptos, private lending. So that's what a self-directed IRA is.
Oh, that's awesome. So it really gives you a lot of control, huh?
Correct. From Madison's perspective, you set up your IRA, you get your funds transferred in, and then you instruct us where to send it. You have full control over the cash.
Nice, like that. Seth, how would someone use a self-directed IRA and keep full control of their own properties, their money, their IRA to make real estate investments? Can you talk about that a little?
Sure, Debbie. So it's actually a very interesting model and it really offers the most flexibility and freedom. It's what we call the checkbook control model, which essentially means we create your IRA, you get the funds transferred in from your current plan, and then we set up an LLC, which lists your IRA as the owner and you personally as the manager.
Oh.
And you'll create an LLC checking account at your own bank and instruct Madison to send your money to the LLC. So you're essentially investing your IRA into an LLC.
That your IRA owns.
Exactly. Your IRA is listed as the 100% sole member of the LLC. And so just for example, if you would look at the LLC operating agreement, it would list Madison Trust Company custodian for the benefit of Debbie, IRA as the owner, and it would list Debbie herself as the manager.
Oh, nice. Nice.
And you would have full control of this LLC. So you'll set up the LLC checking account at your own bank. You'll instruct Madison to send the funds. And at that point, you really have the funds at your disposal to transact as you see fit.
So when you say transact as you see fit, that would include things like a down payment, making your real estate investments, collecting rents from those into your LLC that your IRA owns, paying out expenses from your LLC regarding the property, and just basically running it as a business.
Right. You're allowed to operate in the full managerial sense of this LLC. Right. The way to view it is that your LLC is owned by an IRA. This IRA happens to be yours, but you're operating it and growing this IRA asset. So nice. You have full control. Now, obviously, like Debbie said, you want to keep everything contained within the LLC. So all cash flow associated with the investment would come in and out of the LLC checking account. It's important to keep your personal money away from this and just manage it as a separate entity.
Perfect. Go ahead.
Yeah, it's all doable, and it's a pretty neat product. It's not so well known.
Yeah.
And it's a really neat product, which is, it's gaining steam in the industry.
Awesome. And what seems really neat about it is that as your money is growing from your real estate investments being held by the LLC that you're and managed by you, that your IRA owns, this money that's growing is not taxable, because if you used a Roth IRA, a self-directed Roth IRA, because when you put your money in, you had already paid taxes. And therefore, when you take it out as part of your retirement, you don't pay taxes on either the capital gains or the net rental income from that investment.
The entire asset, this LLC, is all tax-free, especially in a Roth.
Right.
All tax-free.
Nice. And now one of the things I really like about this model is that sometimes I deal with 1031 exchange clients. And what I notice is that because of the strict timelines involving 1031 exchanges, if they sell when the market is high, they still have to buy when the market is high. And likewise, if they're selling when the market is low, they're buying when the market is low. So these self-directed IRAs, they basically allow you to stash your money in the IRA. So you can sell when it's high, just keep the money in your IRA and then buy whenever you feel like it. Is that correct?
Right, and to illustrate the concept of what you're referring to, if John Smith has his IRA in this LLC model, and the LLC owns a certain property it sells, obviously there's no tax consequence because the LLC is getting all the cash back. Nothing's leaving the IRA, and you'll wait till you find a new property without any pressure of any 1031 exchange.
That's really cool. Thank you. All right. And suppose someone just has a regular old IRA or a 401k. Are they out of luck, or is there a way to convert to a self-directed IRA?
So the good news is that you're not out of luck. It's actually fairly simple to convert to a self-directed IRA. And I would actually use the word transfer, because all that's happening is you're creating a new IRA here at Madison Trust. And let's say, for example, you have your IRA currently at Schwab. We'll send Schwab a transfer request saying, please transfer over this and this amount of cash for so-and-so. And they'll transfer it over as a trustee-to-trustee transfer, not a taxable transaction. And then once the cash is here in your Madison account, you tell us where to place it as your IRA investment. So it's really that simple.
Oh, awesome. Okay, and then my understanding is that there are two different types of IRAs. There's the type where you put in your untaxed dollars and then you pay taxes on your earnings when you withdraw them, and the type where you do it the other way around.
Yes, and just to expound upon that, Debbie, so there are two accounts. There's two types. There's traditional and Roth. The traditional refers to the pre-tax dollars that you put in, which all the contributions are tax deductible, but eventually when you pull it out in retirement, all those contributions and gains are taxed at a regular income level. As opposed to the Roth account, which you referred to, that's the post-tax account, which means you put money in which are post-tax dollars, and thereafter all gains are tax-free.
Okay, so when we talk about real estate investments where you're going to get to withdraw your net rental income as well as any capital gains tax-free, you want to do that with the Roth IRA. Is that correct?
So I've seen it done either way. A lot of people like using the post-tax dollars, especially when it's real estate or really any investment they think will skyrocket and have nice capital gains, because they want to avoid any tax consequences. But either way is doable, Roth or traditional.
Okay, so is it possible to convert like a traditional IRA or a traditional 401k into a Roth IRA? How would that work? Would you have to pay taxes when you did it?
Sure, and that's called a Roth conversion. So let's just say, for example, you have a traditional IRA with $100,000, and you want to invest, let's say $50,000 in a real estate investment, and you want that to be in a Roth account. So you could convert a portion of your traditional account, or even all of it, to Roth. The only consequence would be that that amount that you converted is taxable for that year. So if you converted it in 2020, you'd have $50,000 of earned income for 2020. So it's one thing to consider. Right thereafter, all earnings would be tax-free.
So this actually might be a good year to do it, since a lot of people are, suffering from, especially small business owners, out of work, joblessness, and things like that this year.
I've definitely seen clients take advantage of the current situation to do their Roth conversion, yes.
Okay, cool. Thank you. All right. So, tell me a little bit about the details of how one might use their already taxed money to create and make their tax-free real estate investments.
Sure. So the process is fairly simple, right? We would set up a new Roth IRA here for you at Madison Trust. We'll get your funds transferred in from your current Roth account. What most investors will aim for what's called a checkbook model,
Hmm.
which means that we create an LLC which is owned by your IRA. So your IRA is listed as the sole member of this LLC.
Mm.
And you personally, the account holder, is listed as the manager of that LLC.
Hmm.
And you'll create an LLC checking account at your own bank, and you'll instruct Madison to invest your funds into an LLC. That it's your IRA is the owner, right? Your IRA is really a separate entity from yourself, right? It has its own EIN, even though it's associated with your social, it's a separate entity. So it is listed as the owner of this LLC. The IRS knows that it's what's called a disregarded entity because it's owned by a tax deferred or a tax-free account.
Hmm.
And then ongoing, you have total control over the cash from a checkbook status. So, Madison Trust is involved in step one of getting the IRA set up and step two, getting the funds transferred to the LLC. But ongoing, you have total control of the cash. Just, to illustrate an example, right? If you have an IRA at Schwab and you
Hmm.
want to purchase shares in Amazon,
Hmm.
so you click a button and Schwab sends cash. You obviously don't see all the technicalities, but they send cash to Amazon, let's say.
Okay.
Now, Jeff Bezos is managing the money and growing it for you.
Hmm.
So it's really the same thing that's happening here. Right? You have an IRA at Madison. You're telling Madison that you want to buy shares in an LLC. It happens to be that you're purchasing 100% of that LLC, but you are the manager of that LLC. So you have the cash at your disposal in an LLC checking account, and you could purchase the property in the name of the LLC. You'll manage all the cash flow in and out of the LLC checking account. So, as long as you do everything contained within the LLC, you're really just growing your IRA asset. And if it's a
Nice.
Roth, right, if it's a Roth, it's all tax-free.
Yeah.
So there are a few rules when it comes to investing within your IRA, especially with this LLC model where really the cash is under your control, so you want to make sure you abide by the rules. The main thing to be concerned of is what's called prohibited transactions. So you don't want to transact with yourself, your spouse, parents, or children. Meaning, if you own a property, if your IRA buys a property within this LLC, you can't rent it out to a child. So it's basically any lineal ascendants or descendants you want to stay away from. So you want to make sure that all transactions are with third parties, they call it. The term the IRS uses is what they call an arm's length transaction. The reason for this is because the IRS knows the money's in your control, and in order for them to ensure integrity of the account, they want you to transact with people other than those immediate family members that we discussed. That way they know there's no price manipulations. It's just a blanket rule they impose.
My understanding is they're very, very strict on that. Like, you better never spend a night, like an overnight yourself in a property that is in one of these.
They let you function in a strict managerial sense, but they
Hmm.
don't want you at all getting any personal gain from this investment. So you can't live on the property while it's in your IRA. You can't let your kids go there for a night.
No, and the penalties are really severe, right? Like,
Right, yeah, they
mhm,
could bust up the whole IRA, distribute it at a penalty. So
mhm.
you want to stay away from any personal gain. Basically view that you're managing this IRA LLC, total third-party investment.
Yes, yes. Yeah, and my understanding is that also extends to doing work on the property. Like, if the
So,
sink is busted, you do not want to go over there and fix it yourself.
right,
Hmm.
that's also, it touches on a separate point, not
Hmm.
to get too sophisticated, but it refers to what's called sweat equity. The
Hmm.
IRS they want you to function in strictly a managerial sense. So you can use all your managerial skills to manage the property, but any hard labor that's normally serviced out, they don't want you to do. The reason is because they view it that you're contributing to your IRA with actual, what they call sweat equity, with actual service. They only allow you to contribute cash. So it's an interesting rule, but yes, anything that's normally serviced out, whether it's lawn mowing or plumbing, you want to service out to a third party. And even to tie it into the first thing we brought up, you don't want to sort of, if your child is a lawnmower, you can't hire your child to do this, right? You want to keep everything as a total arm's length transaction, never to deal with those prohibited parties.
Awesome. And can you talk about the non-recourse loans aspect as well, and how to leverage your money in your IRA for property purchases?
Right, you don't have to do all cash transactions. In the scenario of the LLC, right, let's say the LLC just has enough money for the down payment. The LLC could obtain financing. There's two things to realize when it comes to using financing within an IRA. First, like Debbie brought up, it has to be a non-recourse loan, meaning the LLC could take out a loan, but it can't be with any recourse to you personally.
Okay.
It touches on the same rule that we were discussing with the prohibited transactions. The IRS is afraid that if you personally guarantee the loan that your IRA is making, they're afraid of what you might be doing on the back end. So they just put a blanket rule that you can never really have your personal assets, your personal self associated with the IRA. That's the reason for the non-recourse loan. Obviously, non-recourse loans are a bit more expensive, but it is doable. The one other concern, it's not really a concern, but it's other consideration you have to realize when obtaining financing within an IRA is something called UDFI. Debbie, have you ever heard of that?
No, what is that?
It stands for Unrelated Debt Financed Income.
Okay.
So it's a cousin of UBIT tax. UBIT is Unrelated Business Income Tax. Essentially what it all means in a nutshell is, right, let's say your LLC owns 50% of the equity in the home, and the other 50% is financed.
Okay.
And after all expenses, you earn a net income of $1,000.
Okay.
So the IRS is not too happy that all that money is going back into your Roth IRA untaxed from money that your Roth IRA didn't really even have.
Right.
So
Okay.
what they want to do is they want to tax the portion of the income that's attributable to the leverage.
Right. I see. So if it was 50% leverage, you would be taxed on 50% of any net gains.
Right. Now that income is called UDFI, that tax on that 50%. And it runs pretty steep, pretty quickly to 39.6%. So it is all doable, and it's something that you and your accountant would take care of. Just for technicalities, it's filed on Form 990T.
Okay.
But the non-recourse loan and the UDFI make obtaining financing within an LLC, an IRA LLC, a little bit, not so attractive. But it is all doable, and I've seen it done many times. But you want to consider the non-recourse loan cost as well as the UDFI tax consequence before obtaining financing.
Yeah, so it sounds like something that works best if your IRA is maybe just like 20% short of the necessary funds, then they can go out and get that 20% LTV loan. And, so that way you minimize your taxes, but you're not barred from purchasing a property just because of shortage of funds in your IRAs. If you need to borrow 100,000 or 50,000, you certainly can.
100%. And just from an accounting perspective, usually the UDFI, obviously each client should discuss it with their accountant, but with all, you can use all the depreciation and all expenses to basically knock down any income. So even though you'll have positive cash flow, it's not really, of consequence to this UDFI, tax.
Nice.
So it is quote unquote avoidable, but it's something to consider. And yes, obviously if it's just for a 20%, you need a little bit of cash. I've seen it done a lot.
Okay, super. Thank you. All right. So let's see, what else do we want to cover? Contributions limits. Can you talk to me a little about contribution limits for these types of things?
Sure. So the self-directed IRA really has the same rules as any other IRA. For 2020, you could contribute $6,000 a year to your IRA, whether it's Roth or traditional. If you're above 50, the IRS allows you to contribute a total of $7,000.
Okay.
What we've seen mostly, because the contribution limits aren't that extensive, most clients who buy these properties are usually transferring over from a current IRA that's accumulated cash, or a current, a 401k with a previous employer they can roll out. So they're usually rolling in cash, and obviously they could continue making contributions to their Madison IRA as if it was any other, but you're limited between $6,000 and $7,000 a year in terms of how much you could contribute. So those are really all the contribution rules. Obviously, when it comes to Roth contributions, they're a bit more sensitive. If you're above a certain income threshold and each person is different, you'll want to discuss it with your accountant. You might have to do what's called a backdoor Roth.
Tell me what a backdoor Roth IRA is and how it would play into this whole picture.
Sure. So there's an income threshold for contributing to a Roth. I don't know the numbers offhand, but I've seen, let's say, many doctors who have a high income limit or a higher income, they're not able to contribute to a Roth. So what they do is they contribute to a traditional IRA, and then they convert it to a Roth. You remember how we discussed how you could convert your traditional IRA to Roth? So it's sort of, they call it a backdoor Roth. It's funny that the IRS has the rule because they know everyone can do it. So why do they make it that you can't contribute to the Roth in the first place? Who knows? But essentially what you're doing is you're contributing money to a traditional IRA, but then converting it to Roth, which basically is like contributing it to the Roth in the first place. And it's just a simple way for people who can't make a Roth contribution to get their money to be Roth money so they can be all tax-free ongoing.
Nice. This is absolutely brilliant. So let me see if we've covered everything. So can you talk to me, I'm sure Madison Trust doesn't do this for free. Can you talk to me a little bit about the fees involved in setting this up and maintaining it?
Sure.
Mm-hmm.
So there's two things to consider here, right? There's the IRA and there's the LLC.
Okay.
Madison Trust provides the actual IRA, right? So we're the trust company that custodies the IRA. Fee schedule, and I'll send it to Debbie, so you'll have it and you can always forward it. But it's $50 to set up the IRA, $50 to send the funds to the LLC, and then the only ongoing cost from there is $75 a quarter. So it's a flat $300 a year to maintain the account here on Madison Trust's end.
Wow.
And we function like any other trust company, meaning that we report on the IRA to the IRS annually. Just the technical forms is 5498 and 1099-R. We take care of all the IRS reporting. We send you a copy for your records. So we function as any other trust company would. And the neat service here is that you have total control over the cash in the LLC.
Yeah, and that's very reasonable. I mean, those prices, I don't know how you guys are making any money.
So it's actually a good question, and I get clients who ask this a lot. Right?
Mm-hmm.
But if you think about it from Madison's perspective, we're really just providing a custodial service, right? Your IRA needs to be held by a third party. The IRS doesn't allow you to store your IRA under your pillow. It needs to be held by a trust company that will report on it. Mm-hmm. So that's really all we're doing. We're not managing your money. We're not investing it, for your sake. We're just custodying the account and sending the money where you insured us. So ongoing, obviously, just to address, what Debbie brought up, we have thousands of accounts with millions flowing in and out of escrow every day for different investment purposes. So obviously, Madison earns on the float like any other bank. But from our perspective, we're really not money managers. We're just providing what's called a custodial service, to custody the IRA for the sake of a self-directed investment.
Nice. That's really interesting.
Now, one thing that I've seen is that it doesn't raise a red flag that you have a self-directed IRA. Sonically, it causes more IRS scrutiny. But if the IRS were to, let's say, randomly audit you, you want to have a clear paper trail of everything being contained within the LLC, and just really be careful. Now, obviously, ongoing, included in Madison's quarterly fee is we offer lifetime support. So if there's any questions, what you could do or what you can't do within the LLC, we're very happy to assist and direct there. But the rules are pretty basic, and they're easy to understand once you just talk about them for a little bit, and we're happy to assist in that regard.
Oh, that's awesome. Thank you so much, Seth. This has been incredibly helpful, incredibly useful. Do you have any final words that you'd like to leave us with?
Great. I'll tell you from my perspective, I really appreciate what you're doing here, Debbie, because what I've seen is that, this is not a product that, I wouldn't consider myself a salesman. I'm not a salesman. I'm not like that, jumpy guy. it's a really interesting and neat product, and it really offers a lot of, control over your money, which is what people
Yes.
want. So once they
Yes.
find out about it, and they have many questions, many of them that Debbie touched upon, uh, once they just find out about it and are comfortable with how it works, they're, they're the happiest camper, and they're very happy to move forward and realize that they could have control over their cash. And, instead of putting in Wall Street and something they don't understand, they could do in something they know about. So if they're a real estate expert, let them invest their money in real estate. I'm very happy to discuss. I know many clients would want to have a conversation on the phone. I'm very happy to do that. So I'll send you, Debbie, my contact info.
Oh, perfect.
Feel free to forward it to any prospects.
Okay.
You can set up a time to talk with me. But it's a really neat product. It needs understanding, but it's very attainable.
Yeah, and that's why I wanted to interview you. Is when I found out about it, I was just shocked that more people don't know about it. Like you said, I think people want control over their money. And as a real estate agent, one of the things I see people really struggling with, well, not struggling, is trying to take advantage of the 1031 timeframes. And this is a way in which you don't have to buy and sell at the same price point in the market. You can really just, sell high, stash your money in the IRA, buy low once the market has changed. And I just think it's an incredible opportunity that I'd like more people to know about, more of my clients to know about. So thank you, Seth, for taking the time to talk with me about this. And I will post this video, send you a copy, and get the word out.
Thank you, Debbie. It was a pleasure speaking with you, and aloha from New York.
Aloha from Hawaii.
Okay.